You've seen the headlines, right? A country's national debt hits some new crazy high record, and it's always followed by some pretty alarming commentary. It kind of feels like a simple scoreboard for a country's financial health. Well, let's dive into this, because the real story is so much more fascinating than just one big scary number. Okay, take a look at this number, 225%. That's a national debt to GDP ratio from a major world economy. On its own, that figure looks, well, absolutely staggering. And by the way, that country is Japan. So your gut reaction is probably to think, wow, that country must be on the brink of collapse, right? I mean, it seems totally intuitive. More debt means more to repay, a heavier interest burden, and a bigger risk of default. But what if that single number, as huge as it is, doesn't actually give you the full picture? What if it's an incomplete and maybe even a misleading way to judge a nation's financial health? The reality, as you'll see, is way more nuanced. And this is where things get really interesting, because we've got this huge contradiction between the headline numbers and what's actually happening out there in the global economy. That simple story of high debt equals bad, it just doesn't always hold up. And here's the paradox right here. You've got countries like Japan and Singapore with these enormous debt ratios, but they're considered financially stable. And then on the flip side, you look back through history, and it's filled with countries that ran into major financial trouble with debt levels that were actually much, much lower. So what gives? This is the core question we've got to answer. If the sheer size of the debt isn't the one thing that matters, then what is? What's the secret sauce that separates a stable, high-debt country from a fragile one? Well, the answer isn't really about how much a country owes, but how it owes it. The secret is all in the structure of the debt itself. This is so crucial. We need to look under the hood at how the borrowing is actually put together. And there are basically three critical things we need to understand to get the real picture. First, the currency the debt is in. Second, who it's actually owed to. And third, the real bottom line cost of paying the interest on all that debt. Okay, let's start with currency. And believe me, this one is a huge deal. If you borrow in a foreign currency like US dollars when you're not the US, you're adding this massive layer of risk. We saw this play out in the Asian financial crisis, where a drop in local currencies made their dollar-based debts just explode overnight. You see, the difference is really all about control. When a country like Japan or the US borrows in its own currency, it can, theoretically, always just create more money to pay its bills. Now, the risk isn't default, it becomes inflation. But if you borrow in a foreign currency, you have to earn that currency, which makes you super vulnerable if exchange rates suddenly turn against you. All right, the next crucial factor is who owns the debt. This is just as important. Are the lenders your own citizens and local banks, or are they foreign investors who might get spooked and pull their money out at the first sign of trouble? Let's circle back to Japan, our prime example. A whopping 90+% of its massive government debt is held by its own people, citizens, banks, and pension funds. That creates an incredibly stable source of funding that just isn't going to disappear overnight. And our third factor is the real cost. A multi-trillion-dollar debt sounds terrifying, but what really hits the budget is the interest payment on that debt. If interest rates are super low, even a giant pile of debt can be surprisingly affordable to manage. Now, the United States is a really powerful example here. While its debt is manageable, the cost of paying for it is becoming a huge deal. Annual interest payments have now blown past $1 trillion. To put that in perspective, that's more than the country spends on national defense. This just goes to show how rising interest rates can quickly turn a stable situation into a real point of stress. So we have these three structural factors, and they're all key. But what allows a country to manage them? What's the anchor holding it all together? Well, it all boils down to one powerful concept: credibility. And credibility isn't just magic. It's built on real stuff, like having strong, independent institutions, a history of sensible policies, and a reliable central bank. When investors trust that you know how to manage your affairs, they're willing to lend you money at lower rates and for longer, which is exactly what allows a country to handle higher levels of debt. And that brings us full circle. This institutional credibility is the final piece of the puzzle. It's the reason Japan, despite that mind-boggling 225% debt to GDP ratio, can keep on ticking without the kind of crisis that a number like that might set off somewhere else.
So, the big takeaway here is that we need to stop just staring at the headline number. We need to start asking better, smarter questions. We've got to totally reframe how we think about national debt.
A quick look at a few different countries makes this crystal clear. Japan's high debt is held up by its domestic investors. For the US, the big thing to watch is that rising interest cost. For a country like Italy, the challenge is that it uses the euro, so it doesn't control its own currency. And for Malaysia, almost all its debt is in their local currency, which gives them a nice safety buffer. See? Every story's different.
Ultimately, this all leads to a whole new way of thinking. The real question we should be asking isn't about how much a nation owes,
but how that debt is structured, what currency it's in, and who the lenders are. This is the framework that helps us see past the scary headline and get to a real understanding of what's going on.
So I'll just leave you with this thought. The next time you see one of those screaming headlines about national debt, instead of just seeing that big number, what's the first structural question that's going to pop into your head?